And this is, of course, return on investment. For the savings, it's kinda easy, and if you log onto your bank, this is stated on your account, and this will normally be a number between 0 to 1% on your normal savings account. You might have a special account which allows for something above 1%. That's great for you, just put it in here. For now, I'll just go with 0.5%. Then we have the pensions. The typical pension fund will invest in indexes or ETFs or the market. So for now, I've just put in these 8%. To be 100% accurate, you would also have to put in the cost of the pensions managing your portfolio. So let's say they had a yearly cost of 1% and you would have to deduct it from this return. There we go. And of course, 1% is on the high end of the scale, but for now, I'll just keep it at 7% for simplicity. Then we have our stocks, in this case, our ETFs and funds. These again follow the market, although with quite a lower cost of managing. Let's say the ETF has a cost of 0.05% and the index funds are a little bit higher of 0.015%. Then I have some growth stocks. And having read through a lot of analysis of the stock, I expect a return of 10% per year, for example. Then we have the emergency fund, which again just has the same percentage of our savings account. And of course our house, which for simplicity, I've just put the appraisal of the house or the gain in value of the house per year, the same as the inflation. But this is at the lower end of the scale and somewhat conservative. For some houses, as there's also a demand increasing, for example, if you're living in the city, and you should also take that into account. But for now, let's put it at 3%. But for this number, you could talk to your real estate agent and see what their expectations are for growth in the area around you. And that also goes for these pension funds. For now, we just put 1% in, but you can of course contact your pension and ask them what is the specific amount, and you can just change here accordingly. Now that we have our yearly ROI, it is time to put in the monthly investments, and for example, I will put $100 in savings. Here, in these pension funds, you are already adding to the pension via contribution in your pay. And that is also why this number here, 5820, is not the same as this. So although you do not insert anything here, these numbers will of course grow nonetheless. Then I'll put 400 in gifts, 300 in funds for example, I'll put 100 into these more risky stocks, and then I'll put the rest in emergency funds. And that is, of course, because I want to grow this a little bit, as this right now is at 11,900, which is a little bit below the 2 months of income before tax, which is the guided amount to have in an emergency fund. And actually, I'm growing this number every month with $157, meaning that in the end of 2026, I should have a little over 13,000. So now you can see that I started with the 1,057 of average disposable income before investing, and now my average disposable income after investing is 0. And that is, of course, because all these numbers here sums up to 1,057. And if we go down to our waterfall graph here, you can now see that we have the input, the tax, the costs, the loans, the loan interest, loan amortization. Now we have savings of 100 and our investments of 957 and a cash leftover of 0. And this means that we have successfully completed the first year, meaning that we have accounted for all costs and all investments, and this allows us to forecast. And the model is made so that by just filling out this 1 year, we can now forecast for 20 years. And I'll quickly show you how that works, because this is the year of 2025. If we go a little bit to the right, we'll see that this is now the year of 2026, which of course, when you get to it, you can fill it out. But for now, you can see that it has just taken all your numbers, which you put in the last year, and just forecasted it by the inflation rate. And under the unlikely assumption that your income doesn't change by more than 3%, your rent doesn't change, or you don't get any other cost prior to last year. But this is the baseline of the model and how it works. And if we go to the right again, you'll see the same will happen in 2027, the same will happen in 2028, 2029, and so on. And if we go back to 2026 here and go down a little bit, the biggest difference here is that now your savings has grown throughout the year with both the interest rate, but also your monthly investments, which you made in 2025. Your pension has grown, the funds, ETFs and stocks has grown by this rate and also the amount which you put in last year. This is the monthly investments for 2026 based on, again, what you did last year, and then accounted for the inflation rate. And now these numbers are grayed out, and that will continue throughout the years as we will only change the monthly investments and the model will do the rest. And you can also see here that your house has increased, your emergency funds has increased, and so on. And if we go down to the monthly cash flow, you see now your income has increased, also your taxes, your costs, your loan interests, and own amortization. This should be about the same. The amount you put in savings, your investments, and actually now you have a little bit more cash left over, which we can go up here now and invest. Let's say we put it in funds, so plus 22. We have a zero here now, and now 2026 is done. And of course, that again is under the assumption that your income hasn't changed and none of your costs changed with more than the interest rate. Let's say you managed to get a raise of $100 per month or $1,200 per year. After tax and pension, that is an additional disposable income of 78, so we can add that to, let's say, the stocks. And this is the methodology. So you have done most of the work in the first year, and now it's all about making small changes. You can also see now that these are grayed out, meaning that this is the amount you have left on your loan. And for the past year, you have already paid off around $3,000. So now you have spent a lot of energy putting in all your numbers, making some thoughts about what to invest, what's your ROI, what your tax is, and you'll pile up all this information in order to forecast into 2026, 2027, and so on. And this is where we go into this tab here called Graph Net Worth. And here I have made a visualization of your budget. And this one is the 2-year forecast of your assets, your net worth, and your total loans. These orange boxes here is the total loans. And if you deduct your total assets with your total liabilities or your total loans, you'll get your total net worth. And you can see here, if you start out in January, you have total assets amounting to $355,000. If you go to January of 2026, so 1 year later, you'll see already that you have assets of $382. If you do the same for the loan, you start out with $200,000 in the beginning of 2025. And in the start of 2026, you have paid off these $3,000 and you have a net worth amounting to $100,000, $85,000. And if we go to the end of 2027, you'll see an increase of around $100,000, a decrease of around $10,000 on your loan, and your net worth being somewhere around $270. And this is to visualize what happens when you're able to cut costs from your budget, invest them in assets, and make money grow for you and not against you. You can also highlight specific assets. Let's say you would like to look at your house. You can filter that in here and you'll see your house increasing from $250,000 in the start of 2025 to $273,000 in the end of 2027. Just looking at this is great motivation already for you to cut costs, but let's see what happens on a 5-year basis. On a 5-year basis, again, you start out of $355,000. At the end of December 2030, you'll have assets totaling around $600,000, so almost a double up. Your net worth will be around $421,000 and you would have paid off nearly $20,000 on your loan. And let's see on a 20-year basis. Here you see your loan is already almost paid out. You have a net worth of just under $2 million and total assets of just over $2 million. And that is, of course, the longer the period is.